So in today's video, we're going to be talking about how lowering the inflation expectation will raise the real interest rates. This is going to be a burden on the economy, but not a lot of people are going to be seeing it this way because they think lowering interest rates will then stimulate the economy and everybody's going to be happy and everything's going to be like hunky-dory after that, or something of that nature. Now, a lot of times when we think about the Federal Reserve lowering interest rates, that's like somehow a good thing. But it's not. Like when the Federal Reserve is lowering interest rates, they're lowering interest rates because there's something bad happening within the economy and they're trying to stimulate again or something of that nature. So anyhow, what we're going to talk about today is the lower inflation expectations and how that begins to impact the economy, or at least through the Federal Reserve's eyes, right? Because we can think about it any way we want. It doesn't really matter how we see it or what we think needs to take place. We're not in charge of monetary policy. It's the Federal Reserve who is. So as you come into this live stream, please go hit that like button so that the YouTube algorithm will grab the video and start spreading it around for more people to join in. This is going to be a really good video, I think. We're only going to be out here for a half an hour, so there's going to be a lot of information that comes out inside of this, especially when we start answering some of the questions within the comments. Wanted to read this. Again, this is coming from the same speech that I always refer back to because it is so telling of what is going on right now. This is Monetary Policy Strategies for a Low Neutral Interest Rate World. However, inside of this speech, there is a section that is very telling to the conditions in which that we are experiencing today, and I think we should talk about it. Here it goes. Let me get my glasses on so I can actually read this. All right. The downward shift in inflation expectation has a second-round effect on real interest rates, the economy, and inflation. When policy is constrained by the effective lower bound, the downward shift in inflation expectation raises the real interest rates, further diminishing the degree of monetary stimulus, making the downturn worse, and reducing inflation even more. Even in times when policy is not constrained, the expectations of below-target inflation in the future affects current decisions, putting additional downward pressure on inflation. In other words, monetary policy is always swimming upstream, fighting a current of too low inflation expectations that interferes with achieving the target inflation rate. Now, this is coming from the Federal Reserve back in 2018, but I think it's very important to understand what it is that they are referring to. When you lower the inflation expectation, you raise the real interest rates. This one is very difficult to try and wrap your head around because, again, when we think about like lowering inflation or interest rates, we think, okay, how does that stimulate the economy? Because people go out there and they borrow this money. All right, borrowing the money to buy houses and cars and go on vacation and stimulate the economy, right? They're using this borrowed money to spend into the economy. Now, if you lower the inflation expectations, right, what you will end up doing is you will have people believing, right, that inflation is not the problem or not a problem, and that purchasing today is not a necessity because you won't have to worry about prices being too expensive in the future, right? You can postpone those purchases. This is when he says that it will, here we go. The expectation of below target inflation in the future affects current decisions. And that is very true, right? Now, if you think about it, if you raise the inflation expectations, this according to this, let's just read this again, but read it in a way that is back opposite of what he is saying. Instead of a lower inflation expectation, we have a higher inflation expectation, right? So let's just see it. The downward shift in inflation expectation has a second round effect on real interest rates in the economy and inflation. When policy is constrained by the effective lower bound, the downward shift in inflation expectation raises the real interest rates. So an upward shift in inflation expectation would lower the real interest rates. Think about that. If you increase the inflation expectation, you can lower the real interest rates. This will increase the degree of monetary stimulus. Think about what happened during the pandemic when everybody would have like this high inflation expectation. The Federal Reserve was keeping interest rates low, really low, causing the economy to run extra hot, right? Extra hot, extra long for an extended period of time. We talked about this quite a bit on this channel. What were they doing? Right? They had the inflation expectation quite high and they had the interest rates set very low, right? If you can raise the inflation expectation, right, you will lower the real interest rates. People believe that if they borrow today at low interest rates, that they would be protecting themselves from the future when prices were much higher. Right? So this is how they were able to trick the economy into, into spending money basically right now. But what's happening today, right? We have the lower inflation expectation. This is raising the real interest rates. This is going to put further diminishing the degree of monetary stimulus and making the downturn worse and reducing inflation even more. So this is what we can expect from the downward shift in inflation expectation, is the raising of real interest rates, putting more downward diminishing effects on the economy, according to the Federal Reserve strategy of what it is that they plan on doing coming into the future, right? I don't know, to me this makes sense. In fact, we just did a video just recently on it where, what was it, the BlackRock CEO or whatever, I forget what his name was talking about lowering the interest rates, but how that would actually put pressure on the economy. Like it was very, very confusing in the way that he said it, but it makes a lot of sense when you take it in from this kind of consideration, that if you have a low inflation expectation and you raise the real interest rates, like okay, let me explain that too, because maybe a lot of times people get that one. I guess I should have probably explained that at the beginning of the video. The real interest rates, right? This is the interest rate in which an investor anticipates they're going to get after inflation. All right. So just to explain it really simply, if you can imagine an investor is going to get a 2% return, but has an inflation expectation of 1%, the real interest rate that the investor will receive is 1%. The return after inflation expectations, right? But if you can lower the inflation expectation, you will raise the real interest rate to 2%, what it is the investor plans on getting after the inflation, right? So if you can lower inflation expectation, you will raise the real interest rates. And this is you can see this taking place right now within the economy, just within some of the statements coming from the Federal Reserve. Like the Federal Reserve has done nothing, right? But take a look at some of the articles that are coming out right now where everybody is anticipating, markets are anticipating, everybody's anticipating this drop in interest rates coming into the future, right? Their inflation expectation is coming down. This is raising the real interest rates right now. Think about that, right? This isn't going to make the economy better. This is going to put a burden on the economy. And remember, if you put the downward shift in inflation expectation, has the second round effect on real interest rates, the economy. When policy is constrained by the effect of lower bound, the downward shift in inflation expectation raises the real interest rates, further diminishing the degree of monetary stimulus and making the downturn worse and reducing inflation even more. Even when times when policy is not constrained, the expectations of below target inflation in the future affects current decisions. All right? This is what's happening right now, putting additional downward pressure on inflation. In other words, monetary policy is always swimming upstream, fighting a current of too low inflation expectation that interferes with achieving the target inflation rate. This is how I see it. Right? This is how I see the Federal Reserve conducting themselves. This is why, even when the Trump administration went to, before they left office, Donald Trump was out there screaming, there's no inflation, the Fed should be printing money, right? Everybody knew that there was no inflation taking place because Donald Trump was screaming it out on the mainstream media. There's no inflation, the Fed should be taking interest rates into negative. Germany is doing a good thing by having negative interest rates. This is stuff that he was saying. I mean, you can go and find this on the internet, right? Donald Trump, I have no belief at all that that's what he truly wanted. None. I believe that he understands the monetary policy better than that. But he did want the inflation expectation to fall so that the real interest rates would rise at the time, right? Which I know is very difficult, but if you think about the timing of it, right? The Federal Reserve was trying to raise their interest rates, the Fed funds rates up. They were doing it on an autopilot thing, right? They were going a quarter point every quarter without question. They were just going to do it. Well, the markets hated this idea. They got to around 2.5% on the Fed funds rate. They couldn't go up anymore, right? Without just the markets just being completely pissed. That's when Donald Trump came out and said, there's no inflation. The Fed should be printing money, and boom, started raising the real interest rates with the dropping of inflation expectations. Totally worked. Right? This is, I mean, to me, this is like, I don't know. To me, when I read this stuff and I think about like how this is going down, it seems so obvious. It doesn't seem like a questionable thing. It just seems like it was very well methodically planned out and executed. It's like happening very, according to plan. I mean, okay, let's read some comments up in here. All right. Yes, there is tremendous demand for dollars outside the U.S. Not only the petrodollar, entire economies are depending on it, especially in urban areas, spending to rural. Yeah. Simon still has to put glasses on to read a speech he knows by heart. Yeah, that's so true. I've read this so many times. There's no way that I should have to put that on. Okay, clickbait. Yes, absolutely. That's the only problem. I have to do clickbaiting titles or else I can't get the information out, right? I mean, if I do very descriptive titles, then they're not catchy enough for people to just go like, oh my God, my life is over, what's going on? And then they click on the title. If I do like something like markets crash and everybody dies, the videos are very popular, right? So clickbaiting titles, yeah, I have to do it. Like I don't like it. I'd rather do descriptive titles so that way they're easier to find later, but I have to do like, or else they just don't get that popular. All right. So 118 of you with 23 likes. Come on, go hit that like button. We'll get some more likes up in here, get the algorithm moving. You know, one of the things, like, I just got to thinking about like this downturn and how the economy is slowing down. And one of the things that I see when the economy is expanding and then when it goes into contraction, working at the lumber yard, this is like one of the things that you see, and you can really only see it if you work the yard itself, if you work a store like I do. And that is like when things are starting to expand, when things are starting to heat up and move, what you'll find is that a lot of people start coming out of the woodwork to do carpentry work, to do remodels, building fences and decks and, painting houses or doing whatever. And you'll start seeing like a lot of these people, like almost like a fly-by-night kind of outfit, right? And there'll be a bunch of them and you'll work with them quite a bit. Like, even some of them kind of know what they're doing. Maybe they work for another, contractor or something like that. And maybe they're breaking out on their own. Right? So as the expansion is happening and things are active and the economy is heated up, you see a lot of these people out there, right? Well, when it turns the other way and things start to slow down, those guys disappear almost immediately, almost overnight. You're like, they're just gone. They're just disappeared. And only the ones who are really well-known, well-established, like, reliable businesses, I guess, out there are the only ones who end up sticking around. And man, are we not seeing that happening here? Like, a few years ago, there was all kinds of faces that I would see coming into the store. And right now, hardly any of them. And the only people that I really see, who are making purchases regularly of building materials to do work are guys that I have known for a very long time. So it's pretty interesting to watch how the recession starts to kick in just by how just by my customer demographics that are coming into the store before the recession actually is declared, All right, let's see what else we got going on here. All right. It's a great title idea. Yeah, I mean, thanks, Brody. But yeah, it's like, what do I do? I mean, it's just like, if I put in there, something really, like I said, really descriptive, nobody really clicks on the title, clicks on the video. I'd like to visit Astoria one day. Do you recommend anywhere to stay? Well, most of the places here are pretty nice. There's a couple of cheaper hotels, but for the most part, they're fairly decent places. If you want like a little fun place to stay that you're not, too worried about the noise, right above the Workers Tavern there's these little Airbnb rooms that you can rent out. That seemed kind of fun, but then you have to stay the night above a bar. So, I don't know. Everywhere in Astoria is cool. It's not really a matter of the places that you stay, it's the places that you visit while you're here, right? Didn't the Fed just announce a reduction in the rate cut or in the interest rates? No, they didn't. That's the credible threats that it's being put out there. No, they didn't. I mean, John Williams just did an interview with CNBC just recently. John Williams is the same guy who wrote this speech, right? This monetary policy strategies for a low neutral interest rate world. He is the same dude who wrote that speech. And if you listen to that interview, they ask him, I was just like, hey, well, you guys put out this, idea that you're going to be reducing interest rates going into the future. And he's like, no, we didn't. A couple of the members of the FOMC in their predictions on where it is that interest rates are going to be into the future have come down. But that's only some of the voting members of the FOMC. It's not the entire FOMC. It's certainly not the entire Federal Reserve, and it's not part of their monetary policy at this time. How it is that the market has taken on, or at least the mainstream media has taken on this belief that they have gotten this promise of rate reductions coming in 2024 is completely false. It's imaginary. It doesn't exist, right? I mean, I understand that there is some members of the Federal Reserve who has stated this, but nowhere in the FOMC, the Federal Open Market Committee, has there come out a statement saying anything of the sorts, right? A couple of the members in their dot plot, in their projections of where it is that they're going to go, has reduced it, but that doesn't necessarily mean that they have voted on this idea, right? So this is the job owning, this is the credible threats, this is the way that the Federal Reserve can adjust interest rates within the economy without actually doing anything at all, right? Because the markets believe this, and if it is true that the Federal Reserve does do it, then, the markets will have positioned themselves ahead of the Federal Reserve, as if the Federal Reserve had already adjusted rates. So right now, this idea that the Federal Reserve is going to be lowering rates into the future is having the same effect on the economy, or on the markets. I shouldn't say the economy, but having the same effects on the markets as if they had actually done it. Just the credible threat alone is enough to do it, right? Because we've learned this from Ben Bernanke's speech when he talks about the gold machine. This is it right here. This is the examples of it. What's the time we got? Okay, we still got a few more minutes here. All right, fly by night and cowboys always come and go. Honest tradesmen and women stay, but it must be tough on the good ones sometimes. Yeah, I can imagine. I'm here. We can start now. All righty, all-nighter. It's good to see you, man. All right, welcome everyone. Colin 12 on the die. Okay. All right. Yeah, I misread it. Okay. So, is there any other questions? Flying over Greenland. Oh my goodness. All right, let me put this up here real quick. I need to block my phone or else we'll end up cooking it. There we go. Yep, so anyhow, this is how I see it going down. The Federal Reserve is going to be using these credible threats to adjust the markets. I mean, already you can even just see like mortgage rates have come down quite a bit. Even over the last 3 months, we've seen mortgage rates come down with the idea of the Federal Reserve peaking out, or not even the pivot. Like I even saw something about a Powell pivot. I haven't seen that yet either, like actually taking place. Just the idea of it. But the markets have put this idea out there. Like the Fed is done. They are not lifting rates anymore. In fact, they are only going to go down from here. And the mortgage market, like if you go and look at mortgage rates for the last 3 months, they are totally predicting this, right? Now, I think it's going to be misread. Like when the time comes, well, let's think about this for just a bit. The Federal Reserve sees inflation coming down right now, but why? They saw it come down because the supply chain is now reestablishing itself. They themselves, the Fed, has been trying to damage the consumer. Don't consume, right? They're trying to raise rates to get you to stop spending. Right? And then at the same time, they were hoping for help from the supply side. The supply side has returned. They come back. They say, hey, this is it, right? Trucking companies are now going out of business because they can't find stuff to haul, right? They are now in, distribution is now taking place again, right? So the supply side is done helping, right? Now it's all about the consumer. damaging the consumer, to make sure that inflation doesn't keep running hot. This is something to think about, because as we go into the future, we have an issue in which that manufacturing is slowing down, right? Businesses are shutting down. Now, if this starts to take place, at the same time, you start having a return on capital investment, right? Because you remember, if you lower the inflation expectation, you will raise the real interest rates. See, this is happening at the same time. There's so many parts going on here, right? So I probably should have like a whiteboard to kind of describe this. But you think about it. You lower the inflation expectation, you raise the real interest rates. All of a sudden, people are now getting a return on capital investment. They can turn that back into the economy and start spending it there, right? See, this is where, like, they're saying, hey, inflation could come back. Yes, it can. It can come back from the return of capital investment that is taking place out there. And it takes a while for this to occur, right? Because the investment has to be there in order to get the return. But once it does, then you can start spending that back into the economy. All of a sudden, you realize you can't slow inflation down, because the exact process in which that you tried to raise rates to hurt the consumer now has the return on capital investment, providing stimulus to the economy, essentially. Right? I mean, this is something that could happen. Now, whether or not that actually does take place, who knows? But it is a real possibility going into the future. Okay? This is at the same time that the slowdown in manufacturing doesn't bring a lot of goods to the economy. Well, if you don't have a lot of goods coming to the economy and you have an increase in demand, all of a sudden you got supply-demand imbalances. What happens to prices? Right? So same thing again. This is stuff that we have to take into consideration. Doesn't necessarily mean it's going to happen, but it could, and we could see it happening ahead of time if we understand what that strategy would look like at the time. Doesn't mean it's going to be taking place. But this is the stuff that I see. This is kind of how some of the things that I think would end up taking place, due to the idea of the raising of interest rates to try and damage the consumer. The longer it sits there, what can happen when you have an inflation expectation adjustment to it, right? Lower the inflation expectation, raise the real interest rates, see what happens from that. All right. So why not just tell people to save money instead of hitting the interest rate? Because you can't tell people what to do. You can never tell people what to do. If you tell them to save money, they won't do it. Tell them to spend money, they won't do it. Like, you can't do it that way. For whatever reason, people will act and behave incredibly opposite to what it is that, that the government wants them to do, right? Unless you absolutely force them to, or convince them that they're going to die. Right? If you can convince them they're going to die, then they'll do it, right? Like, wearing masks or something. But you can't just tell people, hey, just do this. They won't do it. Why hasn't my wife heard the news that the consumer is supposed to be slowing their spending? Because it's not happening. All right. Got a few more minutes. Can you think of a short, clear, simple argument to explain to someone who doesn't really understand the things why they won't cut rates next year? I have friends who are dumping money into markets. Well, I mean, it's not going to be easy to explain in a short, quick way, because there's a lot to understand in order to know why it is that the Federal Reserve is going to keep the interest rates elevated. If you want the shortest explanation for it, it's because of the same reason why it didn't make sense that they were keeping interest rates low while inflation was running hot. Remember this? I mean, inflation was running hot and interest rates were low. And nobody could understand why, right? And they were trying to, everybody had all these political, whatever, right? You got all these reasons. But the real reason is that they were looking for that average inflation rate over time, right? So they had to let inflation run extra hot, extra long for an extended period of time to make up for the fact that inflation had been running persistently under their 2% target for the previous 10 years. This is hard. This is very difficult for people to wrap their heads around, because they don't think about inflation being a problem after the quantitative easing of 1, 2, 3, and 4. Right? Nobody thought about inflation being a problem. It was only the Federal Reserve who was facing an altogether different set of problems from a very low neutral interest rate. That is, the short-term real interest rate consistent with an economy operating at its potential along low and stable inflation. Ironically, the problem we need to solve these days is the risk of inflation that is persistently too low rather than too high. That was the problem. The Fed had an inflation expectation that was persistently too low rather than too high, and it was interfering with their monetary policies. And you can't just explain this. It's very difficult. Low neutral interest rate comparatively to where the Fed funds rate is, right? The low neutral interest rate is the interest rate that is neither accommodating nor restricting the economy. And it was so low that trying to drop the Fed funds rate below that neutral interest rate ran into the lower bound of zero. They didn't have any monetary stimulus left. They couldn't stimulate the economy anymore by dropping of interest rates. This is where the major problems came in. So by letting inflation, by dropping interest rates as low as they did, severing the supply chain, creating the inflation scenario, now they had inflation running extra hot, right? Let it run extra hot, extra long for an extended period of time, because here they're going to start moving their Fed funds rate up above the neutral interest rate well enough to get their ammo back. Right? I mean, this is all like, I can't explain this simply. This is too difficult to explain simply. There's just too much to know, right? But understanding all these different parts and pieces then starts to make sense on why it is that we are sitting in the position we are in, and that the Federal Reserve did not accidentally get here. This is what they needed in order to save themselves. Right? Otherwise, they would be out of business. It would be over. I mean, it would have been a collapse of it. They knew this time was coming. They knew it way back in early 2000 when Ben Bernanke was talking about how to prevent deflation from ever occurring, right? It was inflation that they needed to save the day, and they got it, right? And it wasn't like, I mean, to save the day, whatever the hell that means, you know? I mean, it was just like, I'm not trying to be one that says like, hey man, the Federal Reserve did a great job. They totally saved themselves. They saved us. They saved the world. I'm not trying to say that at all, right? All I'm trying to say is that the Federal Reserve knew that the situation was coming and that they needed to do something in order to save the monetary system, save their central banking system, save themselves. And this did it. This totally worked. All right, what time is it? Cool, I still got a few more minutes here. So I don't know. I can't explain it simply. It's just like there's too many parts to explain. You know. I would like to warn them, but they believe rate cuts will save them. Just understand that there has never been a time that the Federal Reserve had lowered interest rates into good economic times. Okay, I mean just think about it in that sense, right? The Federal Reserve does not lower rates into good times. They lower rates into bad economic times, into slowdown of economic activity. Right? That's when they lower rates. That's not a good thing taking place. It's a bad thing that is happening out there. And I mean, it's not even a bad thing. As good or bad is relative, right? That actually is not really a fair statement to say. There is no good or bad economy. It's just an is, in the position in which that you have put yourself in, right? If people are putting themselves heavily into debt with the anticipation that they are going to be able to refinance into the future at lower interest rates, that could be very damaging. I don't know what the future is going to hold, right? But I believe from the things that I have read and understand and seen from the Federal Reserve over the course of the last 10 years and 15 years since I've been studying this, that the lowering of inflation, the lower of interest rates due to the inflationary scenario that has been depleting, I don't believe that at all. I believe that they are wanting inflation to run extra hot, extra long for an extended period of time, and I believe that they are going to try and keep their interest rates at the Fed funds level incredibly elevated and not going to reduce it, into bad times, but actually allow bad times to start to bring the inflation down so that they can achieve their average inflation rate over time. I know this is so hard to wrap your head around. I mean, you know, it's taken me a long time to even keep piecing this stuff and looking at it to come up with this. Like, I mean, even I myself was like, how the hell did I figure this stuff out? And like, how is it that I even stepped into this theory or into this idea on what it is that's happening here? Unless it happens to be the absolute truth of it, right? I cannot possibly have made this up. Like, I can't, I'm not that imaginative. right? I mean, I wish I could. I'd be writing books or something like that. But this is really what is taking place here. And if you look at the inflation expectation, how it relates to the real interest rates, what it is that the Federal Reserve is attempting to do with their Fed funds rate to try and get their ammo back, when you think about the neutral interest rate, when you think about credible threats, I mean, all this stuff really starts to piece together, and it makes so much more sense. You know, I mean, it's easy to look out there and say the Fed screwed up, get into gold and silver and wait for the dollar to crash, and that's all you need to know, or get into Bitcoin and forget about the rest. Hey, if that's the easy way out that you think is going to work, I mean, go for it. I buy gold and silver, I buy Bitcoin. I mean, let's do it, man. Let's go for it. But I want to understand what is happening here so I can feel like I'm making the best decisions for myself and my family and everything else that I have going on. And this is the way I feel it happens, is by understanding this stuff, you know. What time is it? 30 after. Okay. That was a lot of fun, guys. Let's give it one more question and then gonna jet. All right. The problem the people I was talking about have is that they saw what happened in 2020 and seem to think it will repeat. Recency bias. Well, that's unfortunate because yeah, a lot of people have a tendency to remember, but they also have a tendency to forget, you know, and I don't know. They have a lot of debt to incentive that, Simon. All right. Was a great comment, Carol. Really love that you searched and found something to make you feel better, something that's not unhealthy, like drugs or booze. Absolutely. All right. Okay, you guys are awesome. I see you're all talking here in the comment section. It's awesome. All right. This was a lot of fun. We have 169 people here watching, 62 likes. Go hit that like button. I'm going to end the stream here by hitting that like button. The YouTube algorithm will pick up the video, spin it around for more people to see. And, you know, and we have more discussion on this later on today. All right. Uneducated Economist, you guys let me know.